You are listening to the Greatest Asset Community Podcast, and in this episode, we are discussing some of the reasons why people think that homeownership is not an option for them. Yesterday, I was listening to a lady speak about how she did not believe that homeownership was something that was possible for her. Now, I will say that this particular individual is currently under contract to purchase a home. So very excited about that and happy that she's being able to accomplish that dream that she previously thought was possibly not even something that would ever happen for her. However, it got me thinking, why in the world would people believe that homeownership was something that they could not accomplish? If you know anything about my background, I grew up in a home where both my parents are real estate brokers and both of my parents own homes. My dad at one point owned multiple homes, and we were not rich by any stretch of the imagination. However, homeownership was never something that was not attainable. It was always something that if you wanted a home, you just do the things that you needed to do in order to go get a home. It wasn't this foreign thing that you possibly, would never be able to have or own. And so I've always been around family that, home ownership was always a thing. And so I realized that everybody has not had that experience. And so realizing that, I started thinking the very thing that I just stated: why in the world would people think that home ownership was not attainable? And there's a couple reasons. There could be a number of reasons, but a lot of it boils down really to two. One is the current price of homes, which feeds into how much you can actually afford to pay per month in a mortgage. So the current price of homes is one reason that you might be thinking that, home prices are not something that's in my budget. It's something I might not ever be able to afford because home prices are not going down. They're going to continue to increase, as is the trend over time. Just look at the last 6, 7, 8, 9 decades. Home prices increase. And even when they decrease for a period of time, like in the 2008 recession, they come back even stronger. So that might be one thing. Another thing is the upfront cost of owning a home, the down payment and closing costs that you have to make. So those are the two biggest things that tend to deter people, is what they're going to have to pay per month and what they're going to have to pay upfront just to be able to purchase that home. There are other reasons that some people might get into in terms of, credit. But credit is one of those things where there are so many different ways that you can change your credit picture, your credit profile within a matter of months to get yourself in the position to be able to purchase a home. So I'm not going to dig into some of the things that you have a little bit more control to be able to change, but I'm going to dig into some of the things like home prices and closing costs and down payment that are not in your control in terms of the amount that it's going to cost you to be able to purchase a home. So we'll address down payment first. When it comes to down payment, obviously there are a couple different ways that you can purchase a home. And just so you know, this is going to be geared more toward how you can purchase a home without investing much money into that purchase. Because with home prices and upfront costs being the biggest reasons that a lot of people feel like it might not be attainable for them to be able to purchase a home, I want to discuss how you can make it happen without having to bring much money to the table. One of those reasons, or one of the ways that you can accomplish that, is through down payment assistance. And with down payment assistance, there are some increased costs that come along with down payment assistance. And there's some reasons for that. So one of the reasons, and I'll mention two, one of the reasons is because of the increased risk. The increased risk comes from, statistically, if you have skin in the game, you've got some of your own money invested in purchasing a property, then statistically it is a lower risk for you to default on that mortgage. Why? Because you've got skin in the game. You've got money invested in the property. If you go and purchase a home and a lender or anyone gives you all the money to be able to make that purchase, then if times get tight, you lose your job, hours get cut back, whatever it might be, and you're not making the same amount of money, you don't have anything invested in this house. Someone else took care of all the costs for you. So for you to stop making your mortgage payment, the odds are a little bit higher when times get hard than if you've got $10, $20, $30,000 invested in a property. Now it's like, well, I've got my own money invested in this. I don't want to lose my investment and all of the value that this home has as well. So you're going to do a little bit more. So that's the first thing that causes an increase in, what it takes for you to actually get down payment assistance. The second thing is there are increased costs involved in down payment assistance, and that goes into a few different areas. But one of them is that if a lender gives you $15,000, $20,000 for down payment assistance, that's $15,000, $20,000 less that lender has to put towards someone else's mortgage. So that lender is going to want to get paid for that money. And so if they're giving you that $15,000, $20,000 that they would normally put towards someone else's primary mortgage, that person's going to, excuse me, that person's going to be paying interest on, now all of a sudden they're giving it to you for down payment assistance. Well, they're going to either want it to be paid back in interest, or if it's forgivable, sometimes they're going to charge you an increased interest rate on your primary mortgage to try and help offset some of that cost of giving you an extra $20,000. Because if that's $20,000 more for you, that's $20,000 less that they have to make money off of. And the mortgage industry, the finance industry, is a business, and the players in the game are in the business of making money. So just understand that up front. Another reason why down payment assistance also has increased costs is because a lot of times the lender that you're going through for the loan and the down payment assistance is not actually the lender that's giving you the money for the down payment assistance. What I mean is that a lot of times those down payment assistance funds are brokered out through other lenders. And so if you don't understand what that means, you go to lender A. Lender A is who you go to purchase a home. You tell lender A, hey, I need down payment assistance so I can help cover the cost of down payment. Lender A says, I'd love to help you with that. They take your application, all your information. Now lender A goes to lender B because lender A doesn't actually have money for down payment assistance. So lender A goes to lender B and says, hey, I have a client who qualifies for your down payment assistance program. So I need you to fund the down payment assistance and everything for this loan so that we can get this client a home. So lender B's actually funding everything with your loan, but you're going through lender A. Well, since the money's coming from lender B and lender B's the one that's basically doing, all of the financing, lender A still wants to get paid on this transaction. So lender A charges what's called a broker fee. And that's the fee that lender A gets for bringing you to lender B. They get a broker fee, and that's how lender A gets paid. Well, that broker fee is ultimately charged to you as the consumer or the home buyer. So in addition to paying whatever closing costs that you would normally pay for any home purchase, whatever title and attorney fees, taxes, insurance, you're also going to be paying a broker fee. And that increases the cost of your closing costs. Now, you're not always in every situation going to pay a broker fee. There are some lenders that do have in-house down payment assistance programs, so there would be no broker fee assigned with that. But for many down payment assistance programs, there are broker fees attached to those down payment assistance programs, because many times the lender that's offering the down payment assistance does not have the funds that you actually need. So they go to another lender that they have a broker relationship with, and that's the lender that's actually giving you the funds. Now, if you're thinking, well, why not just cut out the middleman and I'll just go straight to the broker? A lot of times that's not an option. And the reason is because the broker might be what's called a wholesale lender. And so that broker might actually not work directly with consumers. They may only work with other lenders. So you might not have the option to be able to go directly to the broker and just do the loan directly with them. You might have to go through a third party or another lender in order to get the down payment assistance funds, because some brokers, like I said, they don't work directly with the public. You have to use one of the lenders that they partner with in order to get those down payment assistance funds. So sometimes it's just not avoidable in terms of paying those increased broker fees. What you can do is that by knowing about the increased fees that you're going to have to pay, which are going to increase your closing costs, now you know about how you can attack the situation to help limit those costs that you're going to have to pay when it comes time for you to close on a home. So when you are closing on a home, you are going to have down payment and closing costs. A lot of people think that down payment assistance covers all the money that you need for purchasing a home. It doesn't. In many instances, it covers maybe half. In some instances, it covers less than half of the amount that you need. With those increased broker fees and the closing costs, the attorney's fees, origination fees, taxes, insurance, you could end up paying equivalent to what your down payment is or more in just closing costs. So how do you decrease how much money you actually have to bring to closing when you're purchasing a home? One way is by getting more money in down payment assistance. There are a lot of down payment assistance programs that offer two different options. One option is a 3.5% down payment assistance option. 3.5% is the minimum required down payment for an FHA loan. So if you take that option, you're going to receive the funds needed to cover down payment. You're going to be responsible for paying all of the closing costs. But there are a lot of down payment assistance programs that also have a 5% option. And that 5% option is going to give you the 3.5% that you need for the down payment. But that extra 1.5% you can actually put toward helping to cover some of the closing costs. And that's one way that you can reduce the amount that you would actually have to pay at closing. Understand that when you take the 5% option instead of the 3.5% option, a lot of times that's going to come at a cost. Again, the mortgage and finance industry is a business. It's going to come at a cost. And one of those costs is that you might have to pay a higher interest rate for those funds. And so you might have a higher interest rate on your primary mortgage. You might have a higher interest rate on your down payment assistance if it's a repayable down payment assistance with an interest rate attached to it. In either case, you're typically it's going to come at a cost. So know what the increased cost is that is going to cost you to get that 5% instead of that 3.5%. So with every positive, just know what the negative is that's going to come with it, or what the other side of that coin is as well. So that's one way that you can do it. The second way, which I highly recommend, is to utilize seller contributions to closing. And this is where the seller contributes money to helping you close on the home. For example, let's say that a seller is selling a home for $300,000, $400,000. Let's just say $300,000. The seller's selling a home for $300,000. And that seller is going to net X amount of dollars when they sell that home. Well, if you ask for the seller through the purchase and sale offer that you make to purchase the home, you ask for the seller to put $5,000 toward closing costs or $10,000 toward closing costs. If that seller agrees, then when you purchase that home for $300,000, out of all the money that the seller would receive for selling their home to you, they're now going to receive $10,000 less because they're putting $10,000 of that to help you close on purchasing this home. Now, what if you come across a seller that doesn't want to negotiate and doesn't want to pay toward helping you close that home? Another option that you have is for you to offer paying more for the house than what the seller is asking, and then utilizing that increase, having the seller give that back to you so that you can put it toward closing costs. So what that would look like, we'll take the same $300,000 home, you need $10,000. So you make an offer to the seller and say, hey, your home is listed at $300,000. I'm going to pay you $310,000, $10,000 more than what you're asking. But I want you to give me that $10,000 more back to help me cover the closing costs. that's another way that you can still get that $10,000 back, and the seller doesn't have to take it out of their own pocket because you're actually purchasing the home for $10,000 more. Now, this is going to obviously increase your mortgage a little bit. That $10,000 might increase it about $65 or so, but you would thereby get the $10,000 that you need to be able to purchase the home up front. And if you're in a situation where either you're not going to be able to purchase a home, or you pay an increased mortgage of $65, $70 so that you can get the $10,000 back that you need by increasing the purchase price, well, then purchase the home, obviously, is, what my answer or my response would be. Rather than not purchasing the home, pay the extra $65, $70 if you can afford it in your monthly payment and purchase the home. So that's one option that you have as well. Now, it's important to realize that when you increase the purchase price and have the seller give that money back to you so that you can pay closing costs, it's important to know that the home still needs to appraise for that amount. If a home is worth $300,000 and it appraises for $300,000, even though you're under contract for $310,000, the lender is not going to pay the seller $310,000 for you to purchase this home. They're only going to put up as much as the house is worth. So that house needs to appraise for however much more you're increasing the purchase price. So just keep that in mind as well. If you increase it to $310,000, then when the appraiser goes out there to do an inspection and determine the value of the property, that property is going to need to be worth $310,000 in order for the lender to say, okay, we'll give the seller the $310,000, and if the seller wants to give you back $10,000, that's cool. So just keep that in mind as well, is that the higher you go, that home still needs to appraise. And a lot of times homes, particularly if they're really well priced, are not going to appraise for much higher than what they're currently listed at. Now, you do have some homes out there that might be priced under the market or priced under what their actual true value is. And in those properties, you might have a little bit of wiggle room to increase the purchase price so that you can get, the funds or whatever it is that you need to be able to close on that purchase. So those are some of the main ways that you can be able to accomplish purchasing a home without having to put a ton of your own money into it. Again, you've got increasing how much you're getting in down payment assistance. There are also some grant programs out there that can help you and the grant programs, a lot of them are specific to where you live. There are some that are county specific. There are some that are state specific. So do some research, do your research into the area you're looking to purchase in to see what programs are available to you that can help you get the money you need to be able to pay the upfront cost of closing on that mortgage. And to address the other side of that coin, actually, before we get there, lastly, the seller contributions as well. So down payment assistance, grant programs, seller contributions. Those are some of the ways that you can help reduce your upfront cost to closing on a home. To address the other side of the coin that we mentioned at the beginning of this episode is how you can affect your monthly payment. So if you are struggling with what the current price of homes are right now, let's say that you could have afforded a $300,000 home, but now home prices are up in the 400s. So how can you afford that $400,000 payment? There are a couple of things you can do. One is buying your interest rate down. And this is what I personally like to use as the number one thing, if you have this option to be able to do, is to buy that interest rate down, because that's really going to reduce that monthly payment significantly. And you can also get that done utilizing seller contributions. If you have the money to pay your own closing cost, or you have the money to pay your own down payment assistance and closing costs, you can use the seller's money to buy down your interest rate so that your monthly payment drops $200, $250 a month, thereby perhaps allowing you to purchase that home that is $400,000. So that's one way that I prefer to use as the number one way of looking at how can we decrease this purchase price. Well, if you're able to negotiate another 10,000, 15,000 from the seller, that can really help you get that money that you need for the down payment assistance. Not down payment assistance, excuse me. That can really help you get the money that you need for decreasing what your monthly mortgage cost would be. Another way is purchasing a home that is not in a high tax area. So taxes tend to be broken up depending upon the county that you live in. And if you purchase in a county that has a high tax rate, that's going to be something that's going to increase potentially by $100-$200 a month, how much more you're going to have to pay on your mortgage payment, because your taxes and your insurance are factored into your monthly mortgage payment. So by purchasing in an area that has a lower tax rate, you can save a couple $100 a month on your mortgage payment. That's one way. Another way is purchasing a home that does not fall in a homeowners association, or if it does, it doesn't fall in a homeowners association that has really high fees. And so there are some homeowners association in downtown Atlanta. There are some condo associations that have $600 a month condo association fees, which I think is crazy, especially if you're not even getting a pool. But in any case, look at how much the fees are for the home that you're looking to purchase in. There are homes that are in subdivisions that don't have homeowners associations, and there are some benefits to having an HOA. There are some standards at which people have to maintain their homes. Also, some HOAs also maintain some of the common areas as well. So you might get common areas like a tennis court or a swimming pool or a gym to work out in. You might have street lights in a neighborhood that has a homeowners association, because that's something that might be paid by the HOA to just make living a little bit nicer. You can walk around, at nighttime in a lit neighborhood because you got street lights. You might have sidewalks in a neighborhood that has a homeowners association, and that's part of what the homeowners association goes toward building and maintaining as well. So there are some perks to having a homeowners association, but some of the drawbacks, one in particular when it comes to purchasing a home, is that you're going to potentially be paying hundreds more per month depending upon the HOA that you're living in. There are some HOAs that will only cost you maybe a couple $100 a year, but there are some HOAs that might cost you a couple $100 a month. And that's going to increase your monthly mortgage payment, because that also gets factored into the cost of the mortgage payment. So you want to make sure that if you're looking at ways that you can decrease how much you're paying per month on your housing payment, on your mortgage note, look at decreasing where you're living, look at by the tax rate, how much the tax rate is in certain counties, but then also look at the homeowners association that might be present in the neighborhood where you're looking to purchase. And maybe you look at a neighborhood that doesn't have a homeowners association, or you look at a neighborhood that has a reduced homeowners association. Keep in mind, if it is reduced, it can go up. However, at least for the purpose of you purchasing this home, it's going to be calculated at whatever the current amount is. So those are two ways. A third way that you can help reduce your monthly mortgage payment is by shopping around for insurance. Insurance is factored in, homeowners insurance is factored into your monthly mortgage payment. If you shop around with Allstate or State Farm or Geico or one of the many homeowners insurance companies out there, you're going to get different quotes for different amounts. So shop around and realize that there is some flexibility that insurance agents do have in terms of being able to help you out with your price and everything. And so shopping around for different insurance quotes can be one way that you can minimize how much you're paying per month. And I've seen some huge swings in terms of $200-$300 swings in what one insurance company is offering versus what another insurance company is offering. Also, look at what you're actually having covered under that insurance policy. So there might be coverage that you don't need. Maybe you don't live in a flood zone, so you don't need flood insurance added to that policy. You can have that removed. Maybe you're fine paying a higher deductible. So if you pay a higher deductible, now your monthly premium can be less. And if you don't know what the deductible is, that's the amount that you're going to have to pay whenever something happens before your insurance kicks in. So if something that's covered under insurance happens on your home, let's say a tree falls on the roof and does some damage, or a storm comes by, whatever it is, if your deductible is $2,000, that means that you're going to have to pay $2,000 before insurance comes in and covers the rest of whatever it is that is needed to repair whatever item was damaged or broken. That's what your deductible is. So if you pay a higher deductible, then your insurance premiums, the monthly payment that you pay on insurance, is less because you're covering more of the cost. And the higher your deductible, the less opportunity or chance that it is that insurance is going to be kicked in. Because let's say that you have a $5,000 deductible. Well, if you've got a $5,000 deductible, anything that costs $5,000 or less, really anything that costs like maybe $6,000 or less, you're not even going to probably file an insurance claim for that, because one, you're going to have to pay the first $5,000 anyway. And is it worth it filing an insurance claim for the insurance to only cover $1,000? Those are some of the things that go into, okay, if you're paying a higher deductible, you would have less that you would actually pay in a monthly premium. So consider having a higher deductible if it's an amount that you're able to pay, because you don't want something to happen and then you can't afford your deductible, and now insurance is not going to help you because you've got to pay your part before insurance will come in and pay the rest of it. So that is another way, is by shopping around for different insurance policies, but also looking at what's included in the insurance, how much is covered in that actual insurance, and what you're paying on your deductible as well. So those are a few of the ways that you can decrease how much you're going to pay every month in your mortgage payment, looking at how much you're paying in insurance, looking at where you're living at for taxes, living in an area that maybe the tax rate is not as high, maybe in an area where you're not paying city and county taxes, but maybe you're just paying county taxes because you're not in the city limits. Again, there's some benefits that come with that, but there's some drawbacks as well, like with everything. And then the other thing is making sure that if you choose to be in a neighborhood that has a HOA, you're not living in a home that has a high HOA fee, or you just look at homes that don't have HOAs at all. So those are some of the ways that you can decrease how much your costs are going to be when it comes to you purchasing a home. Down payment assistance, seller contributions are huge in terms of allowing you to be able to purchase a home without having to bring much money to the closing table. Taxes, insurance, and homeowners association are going to be huge in terms of you decreasing how much you're paying per month. And this could, all three of those together, if you bring each one down $100, that's $300 a month right there that you could save. Where could you put an extra $300 a month? So really dig into those areas to see, okay, am I purchasing, a property that's going to increase my cost? Or am I purchasing a property that's going to, help me to lessen my cost as well? And these are all things that you need to be thinking about beforehand as well, before you actually get under contract. So those are some of the things that I want to share with you. Hopefully it's been beneficial, because I really desire to help more people believe that it's possible for them to purchase a home. Because I'm going to be honest, I don't believe that home prices should be a deterrent for anyone. And I know what home prices are currently, but I also believe in the programs that are out there to help cross the finish line. And I also believe that there are a lot of options and opportunities that people have that they're just not aware of. There are programs out there that people aren't aware of. There are things that you can do with your credit that will allow you to have access to some of the funds and some of the programs that you currently don't have access to. So some of the stuff is literally just educating yourself, or watching enough, educational content, reading enough books to know about what it is that's out there, that, hey, if I were to increase my credit score to 650, 700, 750. Now I can get access to lower interest rates. And we already know lower interest rates are going to hugely help us to be able to decrease how much we're paying per month. Or if I were to increase my credit score to 700, now I can have access to this down payment assistance program. And that's going to help me get a lower interest rate and get $15,000 that I can put toward purchasing this home. So knowing about some of these other things as well can really help you. So getting plugged in with a good loan officer is going to be, in my opinion, step one in terms of helping you to get where you're trying to go and finding the cheapest or at least costly way of you getting there. So that's what I have for you. Thank you for taking the time to tune in. Take care. Be blessed. We'll see you in the next episode.